Welcome everyone to our Ask the Experts webinar today. We appreciate each of you joining. We're grateful to be able to spend the next hour with you. My name is Bill Maloney. I'm an Executive Managing Director with Riveron. We're looking forward to engaging with you in part 2 of our SPAC series. The 3-part series is focused on guiding companies through the full SPAC lifecycle. You may recall, if you were able to join us a couple of weeks ago, our discussion then was focused on the introductory phase of the SPAC process, forming the SPAC and the IPO, which includes numerous complex accounting and reporting matters. We discussed the process, shared some best practices for elements such as preparation of first-time financial statements, audit readiness, the S-1 filing, and fulfilling other SEC requirements. So we're going to continue the discussion today, but shift our focus to both the target identification and the diligence process there, along with the merger of the SPAC with the operating company. This SPAC merger phase, commonly referred to as the De-SPAC, it's a critical phase, and our team will discuss today how to prepare for the complex accounting and regulatory challenges, including the SEC filings. And then coming up on June 10th, the 3rd part of our SPAC series will be focused on being public and operating as an SEC registrant. We'll spend some time outlining then organizational readiness factors, including how to evaluate the current state and build a roadmap for efficient post-close operations. I'm joined by 4 of my colleagues today who are experts in this space. They're currently working on a number of SPAC deals. Sasha Morozova is a managing director in our Atlanta office. Tony Duesberg is a managing director in our Chicago office. Scott Grell is a managing director in our Denver office. And Josh Motter is a senior manager in our Houston office. Really looking forward to hearing from each of these experts, their experiences as they highlight some of the issues companies are dealing with, and really highlight for each of you what you can be thinking about as you contemplate going public by way of a SPAC, and then address for you some of the common pitfalls that we're seeing out there. Before we jump into the content today, a few key reminders. On our website, riveron.com, you can access all of our previous Ask the Experts webinars. There's a number of key insights on accounting, reporting, and operational topics that are covered there. During the webinar today, we'll include 4 polling questions which must be answered to be eligible for CPE. So please make sure to enable your pop-ups. If they're disabled, you won't be able to see the questions. And we welcome your questions. There is a Q&A option in Zoom that you can use. Please feel free to do that. We'll try to get to those questions, but if we don't, we'll definitely respond separately to you. The webinar evaluation form and CPE certificate will be emailed to you within 2 weeks following the webinar, along with access to the deck today and our contact information. One thing to note, while the on-demand video will be available on our website, the on-demand is not eligible for CPE. So with that, let's dive right in. We'll hit polling question number 1. Which is as follows. Where is your company in the SPAC process? A, operating company thinking about going public. B, currently looking for a SPAC. C, in discussions with SPACs. Or D, not looking. Again, go ahead and respond to that. Make sure you have those pop-ups enabled so you'll see the question. We'll give you a little bit of time to respond to that. And while we're waiting, Scott, let's get started. A question for you off the bat here. What are some of the factors that are driving the significant increase in the volume of SPAC transactions that we're seeing?
Yeah, thanks, Bill. Appreciate it. A couple of significant factors, I think, are big drivers behind this recent boom we're seeing in the SPAC market. First of all, the SPAC market has really become significantly more professionalized. With well-respected players from private equity and banking backgrounds who are forming SPACs themselves and bringing with them the significant abilities to raise capital. That in turn has further attracted owners of private companies who are interested in going public as an alternative to a traditional IPO. Second, the ability for operating companies to increase their market certainty through the pre-negotiation of pricing and other terms of the deal, rather than the uncertainty that you can sometimes encounter during a traditional IPO process, such as market window timing, et cetera. It provides SPAC investors more confidence in the final outcome of the transaction. Okay, with that, let's go ahead and look at the responses to our polling question number 1. looks like primarily about 70% of the folks on today's call are not necessarily in the SPAC process at all, maybe just interested in hearing about what the SPAC process is like, or hearing what all the buzz is about. We have about 12% that are operating companies thinking about going public, and I guess really looking for a SPAC, and in discussions are around the 10% mark as well. So we will make this as educational and informative as possible for all participants today. So let's take kind of a broader look at the SPAC market and really kind of how it has evolved over the last few years. So, you know, look, SPACs have been around for quite a long time. They really kind of came into play in the 90s, but never really gained the popularity that they really started to get over the last couple of years. I think this slide shows you just the significant increase in capital that has been raised over the last couple of years comparative to years prior. So 2020 is really known as kind of the breakout year for SPACs. It was $95 billion raised by 276 SPACs last year. And 58% of all IPO transactions were done through the SPAC vehicle. Compare that to 2021, and this information is basically through April of 2021. We've raised $115 billion through 329 SPACs in the first 4 months of the year. So already outpacing the breakout year from 2020. Additionally, the number of IPOs that have gone the SPAC route has continued to increase to 72% of all IPOs. So, you know, I think the one thing to note that we'll see here is, you know, many people on the call are probably aware of some of the recent SEC scrutiny over how SPACs have been accounting for some of their warrants, whether they should be classified as equity or as liabilities. As a result of that pushback and some of the restatements that have had to occur and just the general slowdown of the market there, only 13 SPACs priced in April, which is compared to 109 SPACs that priced in April 2021. So most tend to see this as a temporary pullback as a result of just some of the restatements necessary to do and kind of making sure that everybody's got the accounting correct before these SPACs do price. But I guess it's up in the air as to whether we'll continue to return to the very high pace of SPACs, or if it'll be tapered down somewhat. I think kind of one just more interesting tidbit of recent SPAC news, I think this is kind of a first. It was announced yesterday that a drug maker company plans to go public with a SPAC and use it to buy back an affiliate that it took public using another SPAC just a couple of years ago. So it's kind of the first known SPAC on SPAC deal, but I think it's interesting. It just shows how the SPAC market is continuing to evolve here. So let's go ahead and take a look at what a typical De-SPAC timeline might look like. This is a very generic timeline. It's a good example. It might be representative, it might not be representative ultimately of what your potential SPAC might look like. And we'll kind of talk on where some of those variables and timing could lie here. So for purposes of this example, we're kind of picking up today, say mid-May, June timeframe. You know, it might be that the company signs an LOI with the SPAC and they begin to negotiate a business combination agreement. I think the key point here is you're certainly not required, or it's common that a company doesn't necessarily start the process with negotiating with SPACs. This is probably most common when the operating company that is considering going public does not have historical audited financial statements, and therefore the time to prepare those audited financial statements is just going to be longer. So we've seen these processes start with SPAC LOIs, and we've seen these processes start with let's start preparing our historical audited financial statements. Just depends on your particular circumstances. So once we've kind of gotten the process moving, you begin to prepare the PIPE materials, and the PIPE is just really it's bringing in additional investors to raise more capital for the deal, such that the SPAC has more capital to buy a larger operating company throughout the process. So the preparation of the PIPE materials, this is a marketing deck trying to bring on investors. And I guess it's important to note here that can kind of be a balancing act of what information do you want to provide to potential investors while your historical audit's going on. We've seen some companies that have very, very good historical audits already completed. Therefore, the numbers should be pretty, not moving around at all, and therefore have no problem with sharing the marketing materials to potential investors. On the flip side of that coin, we've seen other companies that are going through a first-year audit, and the numbers are still moving around quite a bit, and have chosen to delay their outreach to potential investors such that they don't have to make changes to some of the numbers that they've provided to potential investors after the fact. During this process, we'll be working on completing the financial statements, which would include the PCAOB level audit and a stub review for all annual and interim periods that may be required. This would kind of happen from either the May-June or pre-May June timeline, kind of assuming a mid-July filing for purposes of this timeline. We'll talk about it a little bit later in this presentation, but I do want to bring up the fact that part of the overall decision process when you're figuring out what information needs to be included in the registration statement is the 2 versus 3 year financial statement requirement, which is dependent on a couple factors, like I said, but we'll go into those a bit later in this presentation. So assuming that we have the audited financial statements complete, we would target filing a registration statement about mid-July. And then about 30 days later, you would receive those first round of SEC comments. I have another IPO in the process that we just got a comment letter back on yesterday, and kind of true to form, the SEC took every bit of the 30 days to get back to us on the first round of comments. And that's really been very typical. I think with all of the capital markets activity that we've seen lately, the SEC is somewhat bogged down behind schedule, or at least on schedule, and taking every bit of that 30 days to provide comment. So typically while you're waiting for the SEC to get back, companies are preparing the revised S4 with updated pro forma financial information, updating quarterly information to the extent that it needs to be updated. Using our timeline of filing in mid-July, it's important to note that Q1 2021 interim financial statements would go stale on August 12th. So at that point in time, we'd have to update the S4 to include the second quarter 2021 and comparative year 2020 as well. Typically, you see about maybe a couple-week period after receiving the SEC comments before filing that revised S4. And then the comment letter process after the first one typically tends to speed up some. It's usually 30 days for the first, maybe 2 weeks for the next round. And if there's a third round, maybe it's about a week, something like that. That obviously can change very significantly on a company by company basis, depending on what the SEC's comments are and if they're really digging in on any particular comments. Assuming that we could get kind of all SEC comments cleared by mid-September, you would distribute the S4, the proxy, out to the shareholders, and then we usually wait a couple of weeks after that, and then you'll have the shareholder vote, which would typically be that early to mid-October timeframe, with a closing and Super 8K filing that would follow after that, kind of coming in the late October timeframe.
So Scott, just to pause here briefly, you laid out this timeline. Where do you typically see the biggest risk from a timing perspective for companies to stay on track with all of this?
Yeah, so my response may be biased a bit towards the accounting side. I'm an ex-auditor as well, but from where we've been working with our clients, the preparation of SEC compliant financial statements is in many cases the most time consuming and largest variable in the overall timeline. I think some of the challenges that are involved with those preparation of those historical financials is many times we're finding these operating companies that are going public via SPAC are many times much smaller companies, much smaller revenue companies than a traditional IPO company has been in the past. And that's totally fine. The market is very acceptant to that, but we've seen many of these operating companies have never really had historical audits done before. So they may be going through a first-time audit, which is just inherently going to take more time. Sometimes these companies have had audits, but they've been performed by a smaller local or regional firm, and maybe they're stepping up to a much larger national or a Big Four firm as well. And again, just those audits tend to take more time. It's a first-year audit for that new auditor. And in many of these instances, we do see the risk of restatement when moving from a smaller audit firm to a larger audit firm tends to be heightened. And then even if you've had historical audits that have been performed by the company that you want to be your auditor on a go-forward basis, they were likely performed on an AICPA standard audit standard basis. And so those would need to be upgraded to PCAOB standards. And then there's just a general time pressure to get the audits done as soon as possible. So additionally, even for companies that have completed their historical audits, there are a handful of additional financial reporting requirements that are specific to public companies. These include segment reporting, earnings per share calculations, enhanced rev rec, income tax, and fair value disclosure. So we'll go through each of these topics in a bit more detail throughout this presentation. But with that, let's go ahead and move on to our second polling question. Bill?
Excellent. Okay, everyone, polling question number 2. Does your audit firm do any additional work for you? A, yes, they help us think through technical accounting matters. B, yes, they help us prepare our taxes. C, no, we use another firm for all other work streams. Or D, no, all other work is performed in-house. So again, take a little bit of time here to think through that and provide an answer to that question. And Sasha, Scott, will bring you in. Scott just went over the timeline of the SPAC merger, which can be overwhelming for companies, involves lots of moving parts. In your experience, Sasha, what are some of the strategies target companies can employ to get through this process more efficiently?
Yeah, thanks, Bill. You're absolutely right. There's a lot going on during the S4 process. So one thing that been effective for my clients is having a detailed project plan, and the one that would include both going and being public activities with clear roles, responsibilities, and due dates. It's really important to establish a solid PMO structure and accountability. For example, one of my clients, actually, they just filed their initial S4 a week ago. We created a detailed project plan involving all functional areas, so not just accounting, but also HR, IT, MDNA, investor relations, and legal. What's been effective is we meet with those functional leads every week to monitor progress, adjust for any changes in timing, and follow up with all the process owners for updates. Again, project plan includes both going and being public activities, so considerations when the company has to comply with SOX requirements, adopt new standards, when they have to file Super 8K, and then once the transaction is effective, the timing of 10Qs and 10Ks. So really just trying to anticipate everything that's going to have to happen immediately after the company, the transaction becomes effective and the company ultimately is public. So with that, we can check the results of the polling questions. So looks like a majority of you do use another firm, and it does actually make sense, and it's kind of be a nice segue to a next discussion point, because most targets, right, they have to comply with PCAOB standards, and oftentimes auditors would not be allowed to complete any other services. So that answer makes sense to us. And with that, we wanted to spend a little bit of time talking about PCAOB standards, which, as I mentioned earlier, target companies have to comply with as they go through the SPAC merger process. So one of the first critical steps for the company that is going to be acquired by a SPAC is to assess their auditor's independence. Both the company, their board, and auditors will have to determine quickly whether there is possible non-compliance with SEC and PCAOB independence rules, and whether there are any conflict of interest before the target company can proceed with the merger. And this is a really critical step as it might require change in auditors or require SEC preclearance, which is also a process in itself. So I actually have seen audit independence to be a major issue on several of the De-SPAC deals that I worked on, and they almost jeopardized the timing of the transactions. So this is a really most critical step. Also, earnings per share is one of the new requirements triggered by public company GAAP requirements. AC 260 requires that EPS is calculated for all historical periods presented in the proxy. And oftentimes, privately held companies have rather complex capital structure involving preferred units and sometimes multiple classes of shares or common units. So it would be important to go through the analysis, identify all participating securities and whether they participate in companies' profit and losses, whether they have stated dividends, and how do they factor into the calculation of the earnings per share per unit using two-class method. Another new requirement that SPAC targets have to comply with is segment reporting. This is an area of frequent focus by SEC, and actually quite often, to Scott's point, the SEC comment letters could include the questions about segments. Private companies need to take a really critical look at what they're including, what information they're including in the CODM packages to ensure that only necessary information makes it to CODM package, because otherwise it could result in unintended consequences of having too many operating segments or reportable segments rather. And also it's important to comply for the companies to consider, what other information they're presenting to investors, what is included in their PIPE presentations, and what information they publish on the website. It really has to be consistent with the segments that are being disclosed. Another complexity that is triggered by PCAOB standards is the targets financials cannot reflect private company elections. Most often, we see that in amortization of goodwill. Companies are not allowed to amortize goodwill if they decide to pursue a merger with a SPAC, and that amortization will have to be unbound before they can proceed with a registration statement.
Sasha, question for you here as you look at all of these areas that companies are going to be dealing with as they prepare for an audit under PCAOB standards. Which of these areas do you typically see companies struggle with the most?
I think there's really two areas. One is, there's a lot to comply with, right? But as I mentioned, audit independence is probably number one question that has to be addressed because it may result in a change in auditors. And the other one is looking at what a private company accounting elections were done. For example, as I mentioned, amortization of goodwill, it's not just as simple as just adding amortization back. It involves a lot of accounting analysis, looking at what were my reporting units and how do I assign goodwill that I previously accounted for at the entity level? How do I assign that goodwill to reporting units? And ultimately, did I have any impairment that I should have recognized in the previous periods? It usually adds at least a couple of weeks of work involving valuation specialists, and obviously auditors will also have to kind of weigh in on what their thoughts are on this topic. So now moving on, so one of the sections that will need to be included in the proxy statement is MDNA, and it's applicable for both the SPAC and the target. And while MDNA for the SPAC is a pretty straightforward exercise, the MDNA disclosures for the target are a lot more extensive. Good news though, that SEC has recently came up with the guidance that simplified some of the MDNA requirements, and it's really part of their overall project to simplify disclosures. A few notable amendments include changes to contractual obligation table requirements. There's a change to requirement to present contractual obligation table, which normally lists type of obligations and overall payments due by certain time periods. Now instead, companies only need to disclose material cash requirements from non-contractual and other obligations. Selected financial data for the last 5 years, or if the company qualifies as an EGC or emerging growth company for 2 years, no longer needs to be presented. So that is an optional reporting requirement now for the companies. Good news also come around quarterly disclosures. So now instead of using prior year comparative quarter, the companies can choose to use a quarter immediately preceding the quarter. Also, that relates to analysis of net sales and revenue disclosures in the results of operations. Companies had to specify and comment only about increases and what those increases were attributed to, whether they were volume, price, or mix, or new products. Now companies really have to comment on any changes in revenue, whether it's increases or decreases, and provide more qualitative analysis in addition to just quantifying, what the changes were. So that's probably the most notable changes. Obviously, there's a lot more that is involved in the MDNA, and there's a lot more information that SEC has considered. In terms of financial statement requirements, question often arises: how many years of financial statements of the target that need to be presented in the proxy filing? In order to determine this, the company has to be clear on really 3 things. So the first thing is, it's important to determine if the target meets a requirement to be considered a small reporting company or SRC. There are several requirements, but since target is private, only one requirement really matters, and this is whether the target has less than 100 million in revenues. If the answer is yes, then only 2 years of the financial statements will be required. If the answer is no, though, then the second important consideration is whether SPAC has already filed its first Form 10K. The second consideration is very important because the SPAC already filed 10K. It does not matter whether target is an EGC or not. It would have to file 3 years of data. If the SPAC did not file 10K at the time of the merger, there is a third decision point, and this is whether the target meets an EGC status. If the answer is yes, then the SPAC did not, and if the SPAC did not file its 10K, then only 2 years of financial statements are required. And just a reminder to those who are maybe not familiar, EGC status happens when there is less than $1 billion in revenues. If the company is not large accelerated filer and it does not have non-convertible debt of $1 billion or more. And with that, we are ready for our third polling question. Bill?
Great, thanks, Sasha. Okay, polling question number 3. Is your company currently considering an acquisition? A, yes, we have a target identified. B, maybe, we've been thinking about it. Or C, no, we are not looking. And while you answer that, Josh, let's bring you into the discussion here. Is there anything that you would identify in particular during the De-SPAC process that typically catches companies by surprise in your experience? Anything that causes delays during the SEC reporting process?
Sure, thanks, Bill. Yeah, I think one area that catches people by surprise is actually the preparation of interim financial statements. And those interim financial statements oftentimes are not prepared for private companies. A lot of times the AICPA reporting requirements are just such that you have annual financial statements that get audited, and as such, as part of those audits, oftentimes you'll have topside adjustments or annual adjustments of some sort that actually need to be pushed back to each of the interim reporting periods, and that can impact both current year as well as prior year. So Sasha mentioned some goodwill alternative for amortization, right? You might actually have to push that back over the course of 2 to 3 years and have each of those interim periods reviewed. I think another key area that catches people off guard in a similar vein is the timing and quick turnaround that's oftentimes required to update interim financial statements from the stale date. So, for example, you cross over that August 12th staleness date, and all of a sudden your June financial statements are required to be prepared. And if you haven't already done the quarterization, it can cause significant delays in reporting requirements. And then one last thing is just simply the number of people involved in these transactions can be immense, right? So you might have, legal counsel of the SPAC, legal counsel of in-house, legal counsel of the target, accounting advisors on both sides, auditors on both sides, and people reviewing the document in its totality. So a lot of eyes on one single document can oftentimes shock people that aren't prepared. So with that, we'll launch the results of our polling questions here. Looks like C is the dominant answer here. No, we are not looking, which I guess is pretty consistent with the answer to the first polling question, where we saw a lot of people that weren't doing SPACs. So with that, we'll start off by talking about some market changes and complexities. And Scott alluded to these earlier, but the SEC on April 12th issued some guidance that said, to the tune of, we really want companies in the SPAC world to carefully consider the specific facts and circumstances surrounding their warrant instruments, both public and private warrants. And as he mentioned earlier, this has really caused a disruption in the market. We've seen significant decreases both through April and May, and we've seen a lot of backlog with the SEC, as well as audit firms and consulting firms who are trying to push to go through the restatement process for a lot of these SPACs. And before we get into some of the details here surrounding each one, for companies that have already gone through their De-SPAC process and companies that are currently in the middle of their De-SPAC process, this is really a high focus area. And companies that have already De-SPACed are still required to go back and reassess how the public warrants and private warrants should have been treated at the time of their De-SPAC event, as well as any reporting periods subsequent to that time frame. So we've actually seen a lot of public companies that have De-SPACed have to go through the restatement process or prepare a SAB 99 memo evaluating whether the adjustments are material to any of their financial statements. Another client that I'm actually working on currently will have a change in the capital structure as part of the De-SPAC process. And so for pro forma purposes, you really need to think through whether or not you've got a change in the classification of any of these warrants between liability and equity, which will kind of precede the actual accounting for these instruments on the date of close and going forward. So with that, we'll jump into the public warrants a little bit here. So there was, in most of the legal form of these warrants, there's a tender provision that offers the warrant holders virtually the same consideration that would be offered to a common shareholder in the event of a change of control of 50% or more of the common stock. So in most SPACs, there's actually two classes of shares, a Class A and B, and because only 50% of the Class A are offered, you end up not having a change of control in most SPAC transactions. And so as a result, these public warrants are actually treated as a liability. And what does that impact to your financial statements? Well, in breaking it out of equity and into liability, you're required to obtain a third-party valuation in order to value those warrants on day one, as well as each subsequent reporting period, which can both cause significant amounts of time and resources, both financial resources and personnel. And when you think about the structure of these SPACs, right, there's very few in-house personnel that are able to comply with this. So a lot of consultants are involved both for the evaluation of the warrants themselves and the update to the financial statements if a restatement is required. And if the conclusion is to retain those public warrants in equity, there is no financial impact as a result. The private warrants are a little bit different than the public warrants, however, take more or less the same form. The difference is there is no redemption cap in almost all of the private warrants we've seen in the market, and the holder of those warrants actually can impact their value, which is not an input in a fixed for fixed situation. And as a result, the SEC has challenged the presentation. And I think every client that I've had has broken out these private warrants as a liability, again, requiring a third-party valuation and a restatement of their historical financial statements. So while not directly mentioned by the SEC, there are a couple of other instruments that are common in SPAC transactions that companies should really challenge whether they've got the accounting right in lieu of their update for either the public, private warrants, or both. So founder shares, convertible debt with the option to potentially convert into shares or private warrants, as well as what's called a private investment in public equity, commonly referred to as a PIPE. As these SPAC transactions have grown increasingly popular, we've seen a lot more creativity in how these PIPEs are focused. And oftentimes they come with other embedded derivatives and other items that require careful consideration. So moving forward, as we've talked about some of the market challenges and complexities, now let's talk about some of the things that the SEC has done to actually provide relief to companies. So one of the first areas that was passed last year and has become effective at the beginning of this year are some modifications to the Rule 305 test. And Rule 305, it governs the accounting SEC literature over significant acquisitions. So if you're a target company in a SPAC transaction and you've acquired a business within the last year, you may or may not be required to present financial statements on a standalone basis for the acquired company. And that test actually has 3 components, 2 of which the SEC has provided some level of relief on. The first, we'll talk about the income test. So typically the income test has purely been total revenue of the acquiring company over as a percentage of total revenue of the acquired company. And the SEC has now, the SEC has now allowed that revenue test to amend a previous rule that was purely pre-tax income over pre-tax income. So you're able to take the lower of the 2 of those. And so a lot of companies who historically would have had 305 tests on a pre-tax income basis, based on either losses in the period or significant amounts of costs that were incurred that lowers your pre-tax income, companies are now able to also look at those revenues of the target company as a percentage of their total revenues. And oftentimes this reduces the reporting requirements, as revenues of the acquiring company are generally much more significant as a relative percentage. Another change would be to the investment test. The SEC has introduced the concept of an aggregate worldwide market value. Historically, this has purely been purchase price as a percentage of total assets. And so we've seen a lot of relief for public companies able to take advantage of high market capitalization, and therefore provide significantly less amounts of 305 financial statements. And we haven't seen any changes to the asset test. And just as a refresher, that is consolidated assets of the target as a percentage of consolidated assets of the acquiring company.
Yeah, so Josh, as you think about these different tests and some of the changes that you did mention, particularly income test, investment test, any particular area or aspect of one of these tests where we tend to see companies getting tripped up?
Yeah, with the aggregate worldwide market value, I think just the computation of this test, which is really driven mostly on market capitalization, is only applicable to public companies as defined by the SEC. And so oftentimes for these SPAC transactions, if the private company is looking to apply the investment test, that investment test is not going to be able to include this aggregate worldwide market value. And said differently, you are unable to use the implied enterprise valuation that's used as part of the transaction as an aggregate worldwide market value. This is also applicable to entities that are currently trading on an exchange that is not the SEC, a US-based exchange. So those entities are not determined to be public entities for purposes of applying this test. So a lot of companies need to think through whether or not you should be using aggregate worldwide market value or the consolidated assets similar to the old test. So one other area that's provided significant relief as part of these 305s is, we'll focus on this third box here. Historically, 3 years of financial statements has been required had the level of significance exceeded 50%, and that test has been removed. And so the maximum amount of 305 financial statements that will ever be required is two audited periods and 2 unaudited interim financial statements, which provides significant relief for that third year, especially when acquiring a company that might not have as sophisticated a records going back 3 years. The SEC looked and challenged that these financial statements may not be meaningful to investors. And then another part of this rule is significant changes were made to the pro forma financial statements. So looking to the next slide, we have some of the significant changes that were made, and while accounting might not be the most exciting time, these pro forma changes are pretty exciting for nerds like me who really enjoy the business concept here. The introduction of management adjustments really allows companies to provide synergies, management synergies for both a revenue and a cost synergy structure. This is mostly going to be applicable to 305 acquisitions, as that's really where your business might see revenue synergies or cost saving synergies. And this is a significant change for the last about 20 years. There's been 3 criteria, one of which required factually supportable evidence. And this management adjustment column that can now be included deviates away from that, which allows these pro formas to be a little bit more of a marketing document and paint the picture that management might want to display, rather than purely taking into consideration the concept of the transaction and related equity, debt, and cash adjustments that will be enacted through that. One other concept at the bottom here, you'll see the elimination of the non-recurring concept. So one of the other rules over the last 20 years has been that any P&L adjustment would have to have a recurring impact. And so you think through something like transaction adjustments. Oftentimes for pro forma purposes, entities are allowed to back out those transaction costs. And now that that concept has been removed, it could cause some level of more misleading information where your historical financial statements will now have an adjustment to them to reflect the total amount of transaction costs as part of the transaction. So we've walked through a couple of the changes here, and I do want to highlight one other area that's pretty specific to SPAC transactions here, and that's the identification of the accounting acquirer, which can have really significant impacts on the pro forma financial statements as well as the ongoing accounting. And so this is really something that should be done early and often in the process, and make sure that the business combination agreement takes the form that management desires. And so at a high level, the SPAC, generally not determined to be a business, if the acquired company for legal purposes, aka the target, is determined to be the accounting acquirer, the transaction is really in substance a capital transaction referred to as a reverse recap. And what that means is you don't have goodwill or intangible assets. You're not required to get a purchase price allocation and apply that basis of accounting. Now, conversely, if management were to stay on, or we're seeing other transactions take the form of what's called an up-SPAC or up-C in a SPAC transaction, oftentimes those are going to take the form of a traditional business combination where the SPAC is both the legal and accounting acquirer. And this can create an additional work stream inclusive of, getting a third-party valuation, allocation of goodwill and intangible assets, which will have a significant impact for both the pro forma financial statements, timing of the transaction, as well as day 2 accounting for the transaction. So we've talked ad nauseum here on the accounting implications and some of the SEC regs, but I think we also want to focus a little bit here on the business side of the transaction. So with that, I'll turn it over to Tony to talk a little bit about due diligence here.
Great, thank you, Josh. By way of a quick bit of background, just for context, I lead our sell-side advisory practice within Riveron's transaction services vertical. My goal is to spend a little time here today speaking to the business leaders out there who might be planning and or considering themselves a possible target for acquisition. I've spent the last 16 years supporting buyers and sellers of all types in the middle market, including hundreds of successful transactions. While it's really been the second half of my career where I've been focused more squarely on the sell side of things, like anyone on our team, we bring perspectives, having had significant experience working on both sides of the table. On this first slide, you'll see, a properly run sell-side diligence process benefits everyone involved. Speaking more specifically today to our client, the seller, it really comes down to accomplishing three core objectives: speed to close, certainty to close, and maximizing value. As far as speed to close, working collaboratively with a business owner in advance of a process, we can ensure that every stone has already been turned over. You've already taken a position on every question and request that you'll face and be asked to present to a potential buyer. As I mentioned earlier, our professionals have significant experience having worked on both sides of the table. So we work with our sell-side clients to ensure that the deal financials, all of the supporting documentation and schedules, everything that will be requested is already prepared. You've taken a position on, and really you have ready and in hand even before they're requested. As far as the certainty to close, working with our clients, we ensure you're fully prepared to face the scrutiny of potential investors and their buy-side advisors, including financial diligence. As a product of this preparation, you minimize the likelihood of surprises, which may impact the valuation or altogether derail a process just when it counts. The last thing you want is a surprise identified by a buyer at the end of a long process, which could hurt or altogether potentially jeopardize a successful close. Finally, the third tenet of sell-side core objective, maximizing value. Through our collaborative process, we'll work with you to create a report which not only lends credibility in the marketplace to your deal financials, we'll work with you to identify and really highlight the salient points and key insights regarding the value drivers of your business. The questions that really drive those key valuation considerations. The next slide we've included here is really focused on providing just some additional detail of all the various different ways that we can support our clients throughout the transaction continuum. Every process is different and every client needs a different level of support. And we really offer a tailored solution to fit each process and recognizing the unique nature of every transaction. Whether it's sell-side readiness, getting in early to create the gap-based, deal-based financials, to assisting with support through the buyer diligence I mentioned earlier, or in the final stages, assisting with the SPA negotiations towards a successful close. As I said, it's really a tailored solution set, and that's just to name a few of the many different ways that we can offer support to ensure maximum odds of a successful transaction.
So Tony, question for you. If you mentioned, speaking to the business leaders, if I'm one of those business leaders who might be interested in a potential sale? I'm thinking about that for my company. When is the right time to start the sell-side diligence process?
Yeah, Bill, that is a great question. The short answer is you really can't start too soon, but you can certainly wait too long. I'll answer a couple questions at once as a bonus. The most common mistake that we come across by far is businesses who have waited until they're ready and to sell and or have received an offer or interest from a strategic acquirer. At that point, it's difficult to be fully prepared in a way that maximizes the value of a process like this. Our process is a dress rehearsal of sorts. You don't want to be in a situation where you're moving at lightning speed, learning as you go, and all while on stage in front of a prospective acquirer. You only get one chance to make a first impression, right? And I've never had a business owner say they didn't learn a lot of things about their own business during a proper sell-side diligence process.
Good. All right. No, thanks for that. Thanks for that, Tony. With that, why don't we head to our next polling question, which is polling question number 4, and then we'll try to hit a couple of Q&As after that, 1 or 2. But polling question number 4 is, what are the top areas your company needs to address prior to a potential SPAC merger? A, articulating our value and market coverage. B, supporting projected growth. C, development of processes and procedures. Or D, all of the above. So as you go ahead and again provide some responses to polling question 4, a couple of or at least 1 or 2 Q&As here that we'll try to hit on. First one, for Josh. Josh, what do you foresee as the biggest risk to the SPAC market, and do you think there is something that could cause a significant slowdown in the market as we look ahead here?
Yeah, thanks, Bill. Really, it's an interesting time to be in this market. That's for sure. We've seen a little slowdown, and we expect it probably to keep back up. Not really foreseeing any slowdown for the next couple of years, but I think one thing we are seeing is that the companies and businesses that are providing these PIPE financings as part of these SPAC transactions to kind of mitigate the risk of redemptions, we're starting to see that well dry up just a little bit. And as such, as we start to move forward with about 400 active SPACs seeking A, a target, and B, PIPE financing, we're likely to see a scenario where that money ends up running out, and a lot of these SPACs start to dwindle out as part of their 18 to 24 month life cycle without being able to close a business combination. So while we don't necessarily think that this market is going to die anytime soon, the lack of ultimate PIPE funding on a prospective basis could cause some of these deals not to close. And so that could slow down the market in a few years.
Got it. No, very good. Thanks, Josh. One more here that we'll sneak in. Sasha, we talked about a lot of different things today, and want to get a feel from you just in terms of call it the number one thing or one of the top things that companies can be thinking about or doing to get ready for an anticipated acquisition by SPAC or some type of exit event. What would you point them to?
Sure. So there's so many SPACs that are out there right now that even if your company is not thinking about a SPAC merger, that might actually happen before you even decided that would be your strategy. So I would say it's never too soon to start investing into strengthening core accounting and finance functions, and finding ways to maybe improve your financial statement close process and establish solid procedures and controls. That would help you in any scenario, whether it's a strategic acquisition, IPO, or some other exit event. So that's probably a good advice to just always consider it as a good investment option, looking into improving your finance and accounting function.
Good. Okay. Thanks, Sasha, for that. Well, look, thank you very much for taking some time today to join us. In closing, let me just highlight for you real briefly here some of our recent thought leadership, a lot of which is related to the topics we've discussed today. You'll find all of these on our website. And we look forward to meeting with you again on June 10th. That'll be the third part of this SPAC series. We'll be focused, where we'll focus on being public and operating as an SEC registrant. So keep an eye out for that invitation. Again, really appreciate you joining today and being a part of this. Enjoy the rest of your day.